Hi friends, welcome to EduTap. So today we are going to discuss some of the important MCQs which can be framed from the topic financial statement analysis. We already know that the financial statements, they mainly comprise of the balance sheet and the statement of profit and loss. Now the proper analysis of these statements, it's very essential because after proper analysis only we can draw some meaningful conclusions out of these. So now we have different techniques which we can employ for the purpose of the analysis of the financial statements. So let's learn about them in this particular session. So let's start this discussion. The first question is, which of the following is not the objective of financial statement analysis? To assess the current profitability and operational efficiency of the firm, to ascertain the relative importance of different components of the financial position of the firm, to identify the reasons for change in the profitability, financial position of the firm, to identify human resource gaps in the organization, to judge the ability of the firm to repay its debt. So what is financial analysis? It's very simple. What you are doing, you are looking at the financial information which is contained in the financial statements, which are balance sheet and the statement of profit and loss. You are looking at these statements and you are trying to draw some meaningful conclusions out of these. So the financial analysis, it includes both analysis as well as interpretation. So analysis, it means that you are simplifying the financial data which is contained in the financial statements. So you are trying to simplify this data. You are using some techniques to simplify this data, and then you are interpreting it to get some meaningful information out of it, to obtain the meaning of what the financial information is trying to say. Now let's try to answer this particular question. We are being asked which is not the objective of the financial statement analysis. Now financial statements, they are the balance sheet and the statement of profit and loss. Now you are analyzing them. Just think about you are an investor and you plan to put in money in one of the companies and you are analyzing the financial statements. So what is going to be the objective here? You are going to assess the current profitability and operational efficiency of the firm. You are going to get to know, okay, what are the amounts of profits that this company has generated? How efficiently is it working? You are going to get to know the relative importance of the different components of the financial position of the firm. So the financial position of the firm is contained in the balance sheet, which contains assets as well as liabilities, and in the assets also we are going to have different sorts of assets. So we can get to know, okay, of the total of the balance sheet, how much of different asset is available to us. So suppose if the total assets are rupees 10 lakh, how much is cash in it? How much percentage is cash? Cash is supposed 2 lakh, that is 20%. How much are fixed assets? Say they are 50 lakh, so it is going to be 50%. So we are getting to know what is the relative importance of the different components in the financial position of the firm. We can also identify the reasons for change in profitability or financial position of the firm. Now, a very important point here is that whenever we take a look at the balance sheet or the profit and loss statement of any company, you would see that the figure of the current year is mentioned and along with it the figure of previous year is also mentioned. So you can easily get to know how much change is there in the profits or the financial position of the firm, and if there is substantial change, you can take a look at the reasons for this particular substantial change. For example, you get to know that the profits have declined substantially, and then you look at the sale figure and you get to know, okay, the sales have also declined considerably, and decline in sales is the reason behind the decline in profits. Then is to identify human resource gaps in the organization. Now this is not something which is going to be the objective of financial statement analysis. We are also going to judge the ability of the firm to repay its debt. Now this means that a firm should have enough profits that it can make payments of the interest and the principal amount that is due. That is due. So this is what is meant by the ability of the firm to repay its debt. So now we can easily say that the answer is going to be option number D. Except D, all of these, they are the objectives of the financial statement analysis. Let's move to the next question. Which of the following correctly depicts the combination of tools of analysis of the financial statements? Comparative statements, common size statements, trend analysis and ratio analysis, balance sheet, profit and loss account and cash flow statement, standard costing, marginal costing and process costing, branch accounting, departmental accounting and forex accounting, or none of the above. So very simple question is being asked here. So here are the different tools of financial analysis which are available to us. So one is comparative statements, another is common size statement, another is trend analysis, and another one is ratio analysis. Now comparative statements, it means that we are comparing the profitability and financial position of the firm. We are having the figures for two different periods, like we just talked about, that the figures of current year and the previous year, they are going to be there, and we are going to compare them. So such kind of a statement is going to be a comparative statement. A common size statement, in this statement what we do, we try to express each item as a percentage of the total item. Like in the balance sheet, we try to express cash and fixed assets as a percentage of the total of the assets or the liabilities of the balance sheet. So this was basically a common size statement. Then is trend analysis. So we try to obtain a trend. Is it the upward trend which is there, or is it the downward trend which is there? So while looking at the figures for different years, we try to obtain a ratio, and through this ratio we try to look at the fact whether the figures they are rising, whether there is an upward trend or there is a downward trend in the financials of the company. And then there is a very important technique of ratio analysis. It is a very big topic in itself. There are different sorts of ratios which are there. For example, one ratio is current ratio, in which we take a look at the ratio of the current assets to current liabilities. Different sorts of ratios are there from the balance sheet and from the statement of profit and loss. So this is again going to be a very important tool for financial analysis. So now we can easily answer this question, that this answer is going to be option number A, comparative statements, common size statements, trend analysis and ratio analysis. They are the important tools of the analysis of financial statements. Now the next question is, the financial data will be comparative only when same person prepares financial statements every year, same accounting principles are used in preparing these statements, income tax rates remain unchanged, there is certainty about profits of the company, or none of the above. So we have to make sure that the financial data, it is comparative. We can compare the figures of the current year with the previous year. Now this is going to be only possible when which of the following is true. This is what you have to identify here. Now here the concept of comparative statements, it is relevant. Now it is an important tool for the analysis of the financial statements. Now these comparative statements, they show the profitability or the financial position of the firm for different periods in a comparative firm. For example, if I am preparing the balance sheet, what I am going to do, on the one side assets, on the other side there are liabilities, and on the asset side we are going to write different assets like cash, stock, the fixed assets, everything, and we are going to have the figure of the previous year and the figure of the current year. So this is how we are going to write comparative figures. Similarly for the liabilities and similarly for the statement of profit and loss. So we are going to write the figures of the previous year and the figures of the current year, and we are going to compare them. We are going to find the percentage increase or decrease. We are going to find out how much the change has occurred in the figures from the previous year to the current year. So the comparative figures, they indicate the trend and direction of the financial position and the operating results. So we get to know whether there is an upward trend in the revenue of the company, in the assets of the company, or a downward trend is there. Now the financial data is comparable only when same accounting principles and policies are used in preparing those statements. So in one year you are using a written down value method of depreciation, and in another year you are using straight line method of depreciation. So the two statements may not be comparable. In one year you are using this particular policy that you are going to value the stock at the cost price, and in another year you use this policy that you are going to value the stock at market price. So the policies, they are getting different. As a result, the financial statements may not be comparable. To compare the financial statements, you should bring them on the same base. The policies, the principles, the methods, the procedures, everything should remain same if we would like to have a proper comparison within the financial statements. If this is not the case, then there is going to be a deviation and it should be separately disclosed as a footnote. If you are not following the same accounting principles every year, you should definitely disclose it as a note to the balance sheet or the statement of profit and loss. Ki I'm not following the same principles every year. I've changed this principle, because the person who is analyzing, who is looking at the financial statements can make a mental note that this change has occurred and my analysis may not be accurate. Now this analysis is also known as horizontal analysis. So horizontal is like this, vertical is like this. So here what we are doing, we are trying to do this only. We are comparing the figures of the previous year and current year, and we are trying to find out the percentage change, increase or decrease. So this is sort of a horizontal analysis which we are doing here. So this is how a comparative statement looks like. So here we have a comparative statement of the profit and loss of a company. So you can see that this is a statement of profit and loss, and we have revenue, we have different expenses which are there, and we have 2 years, we have the previous year as well as current year, and we are finding absolute increase or decrease, and we are also finding percentage increase or decrease. For example, revenue was 16 lakh in 2015-16 and 16-17 it has increased to 20 lakh. So absolute increase is 4 lakh. And if we talk about in the percentage terms, how do we find out the percentage? We find it as 4 lakh divided by 16 lakh increase divided by the base year figure, previous year figure into 100. So this is going to come out to 25%. Similarly, for all the other items we can do the comparison. For some items there may be an increase and for some items there may be a decrease. Like in the expenses here, we are seeing that the expenses, they have declined from the previous year to the current year. So it indicates a downward trend, a downward direction of the expenses, which may be good. The expenses are declining. This is good. The revenue, it is increasing. It has increased from 16 lakh to 20 lakh. This is again very good. So this is how the financial statements, they are analyzed. So now we can easily answer this one, that financial statements, they are going to be comparative only when we are following the same accounting principles every year. So this is going to be answer option B. Next question is, dash analysis is also known as vertical analysis. Now horizontal analysis was like this. So figures of the previous year, figures of the current year, you find out the difference and you find out the percentage difference. So it was very easy to do it. But now we are being asked about the vertical analysis. So what kind of analysis we are going to do here? We are going to do this kind of analysis. So figures of the same year are going to be compared with the figures of the same year itself. So this is going to be the case with comparative statement, common size statement, trend analysis, or none of the above. So this is something which we are being asked here. Now the vertical analysis, in which the things are like this. We are comparing the figures of the same year with the figures of the same year itself. For example, in the balance sheet, we have different assets. We have cash, we have fixed assets, we have other assets. So cash is 2 lakh, fixed assets are 5 lakh, and other assets are 3 lakh, and the total comes out to 10 lakh. So what we are doing, we are expressing the cash as a percentage of total assets at 20%, it's going to be 50%, it's going to be 30%, and the total is going to be 100%. So this is sort of a vertical analysis, and it is being done through the common size statements. So what we are trying to do, we are trying to get a common size. We are trying to make all the figures come to a common size, and this common size is a percentage of the total assets or total liabilities of the company. And if we try to do this thing in the statement of profit or loss, we will try to portray each and everything as a percentage of the revenue of the company. How much is the revenue the company has earned? We will try to put in each and every expense as a percentage of the revenue of the firm. So these are the techniques of the common size. These are the techniques of the vertical analysis, and they primarily come under the ambit of common size statements. So as we can also look here, this is a common size statement, an example of the common size statement using the balance sheet. So here are the figures of 2 years which have been shown here, but here the figures are shown as a percentage of the total of the same year. For example, for this year ended 31st March 2016, the total is 4150. The shareholder fund, it comprises of the share capital 15 lakh, and this is shown as a percentage, that 15 lakh divided by 41 lakh 50,000. So this is how the percentage is arrived at. 15 lakh divided by 41 lakh 50,000 into 100. So this would come out to 36.14%. Similarly, all the other figures they have been arrived at. So total here you can see 100% for both. And same way we are going to do for the assets as well. So this is sort of a vertical analysis. How we are doing it? We are comparing how the total is related to share capital, how it is related to reserves, how it is related to the liabilities of the company. Similarly, for the assets, we are seeing how much the total assets they are related with the tangible assets, plant and machinery, how much with the current assets and all. So this is a technique of vertical analysis. This is shown through common size statements. So now we can easily answer this question. Answer is going to be option number B, common size statements. Now let's move on to the next question. Which of the following is true about financial analysis? Options are: financial analysis considers price level changes. Financial analysis is just a study of reports of the company. Both monetary and non-monetary information is considered in financial analysis. All of the above are true, or none of the above is true. So now the financial analysis, we are being asked which is true about it, which is correct about it. This is what we have to identify. Now this question has been primarily framed out of the limitations of financial analysis. So these are the limitations: that financial analysis does not consider price level changes. You already know that in accounting we are following this cost concept or historical cost concept. Everything is going to be recorded at their historical cost. Land which was bought in 1990, it is going to be recorded at the same price in 2020, even though the price has increased from 10 lakh to 1 crore. We are going to consider only 10 lakh here. We are only going to consider the cost. So price level changes, they are not accounted for in financial analysis. Financial analysis, it may be misleading without the knowledge of the changes of the accounting procedure followed by a firm. So financial analysis is only fruitful, is only good if similar accounting policies, procedures have been followed in every year by the firm. If from one year to another year a firm changes its procedures and policies, then the picture may be misleading. Financial analysis is just a study of reports of the company. So there are some reports of the company and we are just trying to study those reports, and they primarily comprise of the balance sheet and statement of P&L. Monetary information alone is considered. So we are only going to see the figures in money terms. We are not going to see any other figure. All the non-monetary aspects, they are ignored. So we are already ignoring how good is the human resource of the firm. Are there any disputes in the firm? Anything which is not measurable in money terms, it is totally excluded from the financial statements as well as financial statement analysis. So the correct answer here is going to be option number B. Because price level changes, they are not considered, and only monetary is considered and non-monetary is not considered. Answer is option number B. So friends, this was our today's discussion, a very short one on the financial statement analysis. We try to understand how the financial statements, they are analyzed using the different tools of the common size statements and comparative statements. So this is what we have tried to understand here. There are other techniques as well, like ratio analysis is an important technique. We are going to deal with it separately in a separate lecture. So that's it for today. Thank you. Bye bye. Take care. All the best.